Well, this is the week that American businesses have been dreading for some time. Most on Wall Street believe that precisely at 6 p.m. on Wednesday evening, American business will become $15 billion poorer this year. You may ask, how does that happen? Today, a look at the arcane workings of the Federal Reserve Open Market Committee. Welcome, it's Monday, March 19th, and this is Value Side. I'm your host, David Ravel. Well, early Tuesday morning in the Mariner Eccles Building in Washington, D.C., the Fed's Open Market Committee will meet for the second time this year. Their principal task will be to set the Fed's target interest rate. And by all indications, they will likely raise their benchmark Fed funds rate 0.25% to 1.75%. And because the Fed funds rate is the foundational rate upon which most other interest rates are calculated, it will mean that we will all pay slightly more for all of our loans. For the consumer like you and me, that will eventually translate into higher credit card interest, mortgage interest, and interest on all installment debt. It will mean the same thing for businesses, but here the amounts are much higher. Since the financial crisis of 2008, the country's businesses have been on a borrowing binge. Over 30 years of lower and lower interest rates look like they would go on forever. Their mottos seem to be, borrow today and refinance tomorrow at a lower rate. For many corporate managers, this ability to borrow at extraordinarily low rates meant that they could enhance their corporate returns by simply increasing the leverage in the company. Now, when we began the financial crisis in 2008, non-financial corporate businesses had an outstanding debt of nearly $3.4 trillion. Today, just 10 years later, that debt has nearly doubled to over $6 trillion. And if the FOMC holds true to form, the interest on all debt will rise 0.25%. Now, that may not seem like a lot, but on that $6 trillion of total business debt, that translates into an added $15 billion in interest payments per year. So for the first time in a generation, businesses are looking at a rising cost of debt financing. If anything, the American businesses find themselves in a good news, bad news situation. The good news here is that not all that $6 trillion in debt will have higher rates in 2018. The long-term debt will not see an increase until it becomes due and is rolled over. The bad news is that all the financing and short-term financing like inventories, lines of credit, and any maturing short-term loans will all bump up in their interest when they are rolled forward. Finally, if there is one message coming out of Wall Street, it is that businesses are likely looking for 2 and possibly 3 more rate hikes after this one, as the Federal Reserve seeks to normalize their interest rate policy. If all goes according to the Fed's plan, that's an additional $60 to $75 billion in interest rate charges the businesses will incur by the end of the year. As you can see, normal to the Fed translates to expensive for businesses. For an inside baseball perspective on the FOMC meeting, the Open Market Committee operates with the 7 members of the Fed plus the president of the New York Fed as standing members, and then each year rotates through 4 of the 11 regional Fed bank presidents. Now, it turns out that the 3 biggest doves, that is, members who are likely to vote against raising interest rates, are not voting this year. So James Bullard of St. Louis, Charles Evans of Chicago, and Neil Kashkari of Minneapolis will not vote. And without the doves, it makes it even more likely that rates will go up, and possibly 4 times. Now, on the economic calendar, there are no scheduled reports due out today. However, Raphael Bostic, the president of Atlanta Fed, is scheduled to participate in a forum in Miami. On the earnings calendar, a light day today, highlighted by a prominent tech company, Oracle, the developer of database, middleware, and business application-based softwares and hardwares. Oracle will report earnings after the market closes. Also up today in earnings, Condor Hospitality, a hotel real estate investment trust, Health Equity, a technology platform provider for health savings plans, and Citrix Corporation, a developer of cancer treatments, all due to report earnings today. And that brings you up to date on the investment markets for today. We'll be back tomorrow to see how we did. This has been a copyrighted edition of Value Side, published before the opening of the New York Stock Exchange for Monday, March 19th. Don't forget, you can hear Value Side on Google Music, SoundCloud, iHeartRadio, the Apple iTunes Store, and now on YouTube. For all of us at Value Side, I'm David Ravel, hoping you have a great day.